Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Ryan McCormack, Factor and Core Equity Strategist at Invesco, to discuss weekly trends in the Nasdaq 100 Index as well as interest rate implied probability. Ryan, it's great to see you as always. Welcome back to Trade Talks. And since we spoke last, we got key jobs data, we got the CPI data this morning, and it was interesting to see the reaction with the market like,
Yeah, pretty much market kind of shrugging its shoulders and a lack of direction. For the week, we saw growth kind of back off. We had QQQM and QQQ down 1.03 and 1.04% respectively, underperforming the S&P 500, which was up 24 basis points, and the S&P 500 value up 0.58%. Really, the big down day was on Wednesday of last week. After weakening economic data, we saw a pretty soft ISM services figure relative to estimates, and an ADP employment change that was much lower than estimates. Thursday brought initial jobless claims that came in higher than anticipated, and a very big revision to the upside from the previous week's figure. So, I think a lot of this kind of fueled some concern about the potential for a soft landing, and investors kind of looking for direction, not to mention a long weekend thrown in there.
right. So we see the data, it's coming back in, it's aligning to what the Fed's strategy is trying to achieve. What are you seeing now when it comes to interest rate and implied probability at this point?
Yeah, so it's interesting. We're seeing it a little bit higher than last week, and today was kind of a big day, right? We saw March CPI figures, but they came in right around expectations. CPI year over year was slightly below estimates, 5% versus 5.1. Month over month came in at 0.1%, better than estimates for 0.2%. The core at 5.6 was right at analyst estimates, and we saw yields drop pretty considerably right around the announcement, and then they crept back higher during the day until the release of the March FOMC minutes at 2 o'clock. We started to see the 2-year yield back off. So, unsurprisingly, you comb through the minutes and you see that there's much more emphasis on the banking center, given what happened the week of March 8th, 9th, 10th. And around that, the potential for tightening credit conditions, right? How that will weigh on future economic activity and inflation, and ultimately lower the committee's assessments of, where they're going to land on the Fed funds target rate. So, I think when you're looking at what the policymakers were saying, it's 5.1% this year, which implies, one more rate hike higher by a quarter point. And with that, you have Fed funds futures last week saying, maybe we'll get a 25 basis point hike in May. We actually had more folks thinking that there wouldn't be. The Fed would hit the pause. Now we see an implied rate hike higher, rate move higher of like 0.18%, which means more are expecting a quarter point hike. So, I think the reaction ultimately has really been muted. Now, when you're looking at the Fed funds futures, if you do see that hike in May, it looks like from that point forward, the Fed is going to hit pause and potentially even cut. And that kind of coincides with some of the Fed commentary saying that we could see a mild recession in the back half of this year. But ultimately, I think markets equity markets at least have largely shrugged this off and, kind of data dependent, much like the Fed is.
Right, makes you wonder if it's actually priced in at this point, because there really wasn't that much of a reaction in the markets looking 6-9 months out. If we take a look at last week and this sector performance, what stood out to you?
Yeah, so two sectors in negative territory for the week: technology and discretionary, which two of Nasdaq 100's largest overweights. That explains pretty much all of the underperformance against the S&P 500. Overweights to Apple, Amazon, and Microsoft were the biggest drags on relative performance. Apple was the largest detractor as the company came under pressure after IDC reported that Mac PC shipments fell by over 40% in Q1 year over year, and its market share fell from around 8.5% to 7.2%. Really, all major PC suppliers or PC makers saw declines of at least double digits in terms of shipments. Apple was by far the largest, but ultimately Apple had made mention of this in their previous earnings commentary, talking about double-digit decline around PCs and iPads, and I think it sort of just goes along with the trend of what we've seen in this kind of post-COVID world, right? So some of that upgrade in PC market wearing off, but ultimately, Apple is scheduled to report in about 3 weeks, so I think we'll keep an eye on any comments around further PC softening.
All right, Ryan, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.